Good afternoon, Friday. Vix Trader here again for Friday, um, November 23rd, 2018 for the holiday market trade. I want to talk about something I didn't discuss in my previous video. It's my strategy. Today for the day, it's the end of the week. I'm going to close out any positions I have for a profit. These are my positions: 75 at 45.80, 50 at 48.90, and 30 shares at 49.24, which you got at the end of the day around 3 o'clock. So I'm down on these positions, but I tend to sometimes to make money. I tend to hedge, and I use hedging this inverse vehicle of SVXY. This thing is another VIX. This one goes up in value, SVXY, as the VIX goes down. So as the VIX goes from 20 to 11, we'll say this thing goes up in price. As opposed to TVIX, goes down in value as the VIX goes down in price. And I'll tell you why I do I use as a hedge. Both of these vehicles, the SVXY and the TVIX, in the long run, they go down in price. You see this past year, this thing's gone down. So we had the February crash. It went from it looks like 50 to 150. True, but look, the rest of the year, as the market was essentially going up to the all-time highs, it kept going down. Now the February crash brought this thing from, this really isn't accurate because it's reflecting a reverse stocks play, but this thing I remember because I shorted it at 139, and it went all the way down to really was $5. They did a reverse stocks play of 8 to 1, but it went all the way down to $5. So I use this as a hedge. These vehicles, people like to use them to go long, but to me, that is the wrong way to use them. You can use them as a hedge if you have a retirement account or a long position, just a regular trading account, and you're afraid of a market going down. Instead of going long these TVIX, which means eventually the market will rally. Rallies last 9 years. A bear market lasts 1.4 years. This thing will eventually just go down and you lose all your money. A better option would be it just take 3 to 4 or 5% of your portfolio and short the SVXY. As you see, so in case of a market crash of 20, 30, 50%, yes, your portfolio will be down and you can dollar cost average it in, but you can minimize some of your losses by shorting the SVXY if your broker lets you. You can't do it in an IRA or a 401k, but you can do it in a regular margin account. So you can open up a separate margin account, and to offset some of your IRA losses, and say, hey, I have $100,000 IRA, but I'm going to short, 100 shares of SVXY. And so in case of a market crash, I could make $5,000 as this thing will go down like 90%, in the event of a market crash. So sometimes, instead of like closing these positions out for losses, because these things could rally to $60, $70. What I'll do is I'll open up a short position in SVXY, and what will happen is if the market rallies, I'll close this position out, and these things will go down in value, and I'll make money here. Or if the market crashes, yes, I'll be down in this position significantly, but I'll still make money. In that I'll close out this SVXY position for a profit and take those funds and short shares of TVXY at like $80, $90, to dollar cost average it up as it starts to, in the market rallies, it starts to go back down again. Because in the long run, there's spiders. It goes, we talked about long term, the market goes up. Bull markets last 9 years, bear markets last 1 year. So that's why I use them as shorted vehicles and not long vehicles. I hope that's helpful. Vix Trader here again. Thank you very much.